Host of the Professional Edge. My name's Todd, tax attorney, CPA, and certified financial planner. And we're talking about small moves to give you, our listeners, big results. So we talked about a couple things. A, moving part of your RMD, your required minimum distribution, to a charitable contribution directly. That way you don't have to include that amount in your taxable income, where a lot of our clients are actually getting the larger standard deduction. So a lot of times when they're making these charitable contributions, they're not making them from that required minimum distribution, but they're actually making that contribution from their bank account, let's say, cutting a check to the charity of their choice. And unfortunately, then the individual's not going to be able to benefit from that charitable contribution. So let's just restructure things. Let's make a small move the portion from the required minimum distribution and have that paid directly to the charity of your choice, and therefore you're not going to have to claim that in taxable income. Next thing we would do is then qualify for the larger standard deduction, so we're actually getting a tax benefit from the monies that were given to charity. Yes, there's a little plug number on the front side of your 1040 tax return for standard deduction filers for part of that charity, but we're talking about more charitably inclined individuals. So again, that's another way that we make these small moves to get a big result, and it's a combination of these small moves that results in that big result. It's just not one planning proposition. It is simple, very strategic things that we place in for our clients. We implement these types of strategies, making all these smaller changes we talked about, reducing down the average cost of a mutual fund fee. It runs at 1.44%, 144 basis points. If we can drop that to 40 basis points for our client, keep the same diversified portfolio, then the client actually is going to receive that 1% additional rate of return in their portfolio. And on a $500,000 portfolio, that becomes significant money. That's $5,000 a year. That is roughly $400 a month. Think about this. Every week I give you a new $100 bill. It's yours. You were paying for it before you listened and started working with estate management counselors. You were paying it, but you didn't realize it. But now, in actuality, I'm going to hand you a new $100 bill every week. Start Monday morning with a brand new $100 bill. Now, you say, okay, that's pretty cool. That's not going to go very far. But, you know, most of our listeners here on the Professional Edge are savers, and they're not going to spend that $100. They're going to keep part of it. They may spend $80 the first one I give them. But you know what? Monday morning, you get another $100 bill. So those are the simple things that we work on to generate these big results at the overall scheme and planning for our clients. So let's talk about another small move that gives a big result. We look at titles on real estate. Being a tax attorney and doing estate planning work, we look at titles on real estate, and a lot of our listeners have second places that they rent out to friends, family, put it on Airbnb, VRBO. And lo and behold, when we start having this discussion, it says, okay, we're reviewing your portfolio, but we also put our hat on because it doesn't make any sense not to address exposure to risk. Now, everybody's very familiar with stock market risk. We all know the market could go down. When COVID hit, the market went down by 30% in a month. The quickest decline in recorded history for the stock market. So when we look at that, we say, all right, everybody's aware of risk in the stock market, but what about that risk associated with your condominium down in the Panhandle? Just say, hey, bring in the title to that property. And they say, well, I still have a mortgage. Do I have a title? The answer is yes. You have a warranty deed, and that will address who the legal owner of that property is. And lo and behold, they're renting it. They've been renting it for 6-7 years. They've accumulated some money outside of their 401k and IRAs. They have some real estate, very nice home. And lo and behold, the condo that they started renting out, when they originally bought it, they were using it only for their family. They then started renting out. They've been doing this 6-7 years, and it's still in their individual name. Well, if you evaluate the risk is significant, because now if someone gets hurt, one of those VRBO owners or renters, not the owner, but the VRBO renter comes in and unfortunately they get hurt on your property, they're going to most likely engage a lawyer because they solicit these types of injuries, and your policy limit might be $300,000 of liability, but for some reason the jury awards $1 million verdict. So with that $1 million verdict, we then look at it and say, okay, your policy is going to pay $300,000. Where are you going to get the other $700,000? Well, that's when they start asking you, what else do you own? What land do you own? What's in your bank account? What cars do you drive? And what's the address of your principal primary residence? So again, this is a small move to get a big result. The small move is, let's address this risk in that asset. Still own it, but now we need to isolate that liability so it can only consume the condominium that you have or the townhouse that you rent out. And therefore, when I say consume, you would hit the policy limits, and the worst case scenario is you sign over the deed to that condominium and you're free and clear to go forward from there. So again, this is a small move to isolate that liability to protect you from the adverse risk of a $1 million verdict against you. And again, this is another small move to get a big result. The small move, we put a liability fence around that property, and therefore, if something tragic happens, then we're not going to have an individual claiming a satisfaction of a judgment against your sale of your principal primary residence. Unfortunately, we are in a litigious society. So again, you say, all right, I thought estate management counselors was a registered investment advisory firm and you manage portfolios. We do, yes, and we do it very well, in my opinion. Our clients think so too, with our very 98% client retention ratio, which I'm very proud of. But when you look at that, I think you as a listener here on the Professional Edge, these are these outside things, being a tax attorney and a CPA, that we bring to the table for our clients at estate management counselors. So to have that discussion, if you like what you're hearing and you want to have a personal discussion, give our office a call at 877-654-9798. That number again, 877-654-9798. You can also check out emcthebundle.com. That is Echo Mary Charlie thebundle.com. And that's where we've combined the estate planning side with the financial side, being a retirement income projection and also a tax planning strategy that works for the individual client. So again, to get started, 877-654-9798. That number again, 877-654-9798. So back to that rental property that you have. It could be a condo in the Panhandle, or it could be a duplex that you have, or you inherited grandma's house and now a family member is living in that house and they're paying you some rent. And I will tell you, family sues families. So don't think that because somebody's related that they're not a potential creditor against you and your assets, because they're there. So why even take the risk? Let's do a small move. Let's put a liability protection fence around that property. And the big result is now you protected your other financial assets from the claims of that potential creditor. Again, it is a very small move that you need to take. And you need to take this before the accident happens, and have any lawsuit being filed. You can't do it afterwards because they'll set it aside. The judge doesn't like you post tragic accident planning to try and put this liability protection around your property. So let's do it now while you have the time. You're spending a lot of more time at home with COVID. We're not going out as much. We're not going to the movies. So now's the time to make that small move to get this big result. So there's the other thing that we need to do. So what other small moves can we do to get a big result? Well, let's think about this. For tax planning, we're on time to file our taxes by 4/15 this year. There's no extension as of right now. As we did last year in 2020, we were allowed to go to July 15th to file our taxes. The extension time was allowed for us. And, you know, you might hear some background noise recording this remotely, which is pretty incredible with today's technology. So when I look at that, you know, a small move gets a big result. This is a case in point. Start a business. With that, you say, why would I start a business? Well, a lot of our itemized deductions, again, the standard deduction has went up significantly until it sunsets in year 2025. So at that point, we need to plan and be a little bit more intentional about what we do with our affairs. So the IRS says to be in business, you must have the intent to make a profit. So if you are into painting and you buy canvas and you open up on one of these, you know, websites that you can sell your paintings on, it's pretty simple, straightforward. You can build your own website or have somebody build that. And even the cost you pay somebody to build your website could be a tax deduction. And then your supplies, your canvas, your brushes, your things that you use, your easel. Once you get everything situated, those are all deductible, valid business expenses because now you're operating a business. It's no longer a hobby. You're trying to sell some stuff to make more than what it costs you to do this. So when you move those personal items from your individual non-deductible side to the personal business side, then we can actually generate a loss that you would show on your tax return. And a business use portion of your computer would also be able to be allowed as a deduction as well. So again, these are the small things, and we'll touch on this in the next session. But this is where you start a business to move some of these non-deductible, for tax purposes, expenses that you incur over to a deductible business side, and therefore you're going to get that advantage of reducing your tax liability. My name's Todd, tax attorney, CPA, and certified financial planner. We're going to have more coming up here on the Professional Edge on small moves to get big results.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Todd help you implement an effective estate plan. Call 877-654-9798 today. As a tax attorney, CPA, for over 15 years, Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.